Welcome to my presentation on fixed assets and specifically calculating depreciation. This presentation will focus on the actual calculations you need to do rather than the background of fixed assets. So make sure you have an understanding of that first and then watch this presentation to help with your T accounts and with the general calculations involved. Just before we get started, a quick introduction to myself. I'm AAT qualified, studied level 2, 3 and 4. I'm currently working in finance and have been now for 2 years, but my ultimate ambition is to train to teach AAT in the future. The presentations that I do are just about the key concepts of AAT and they're designed to support the fundamentals that will help you progress through levels 2, 3 and 4. I'm not endorsed by AAT and these materials are my own. I hope these help and prove to be beneficial, and good luck, and most of all enjoy the journey that is AAT. Okay, so a recap then on actually what depreciation is. Hopefully you will already have a good understanding of this from your other studies and we can move on to calculations shortly. But just very quickly, depreciation is the reduction in value of an asset over its useful life. So when a business purchases an asset, it will decide on what it thinks its useful economic life is, and that can be done over a number of years, and they'll also decide if at the end of that time period do they think that there will also be a residual value to that asset. So you really need to consider that you really need to think of depreciation in terms of that the value of that asset is going to reduce over its useful life. Okay, so if a business purchases something, a fixed asset for say £500 in 2017, and they say it's going to have a useful economic life of 3 years, then that asset is not going to be worth £500 in 3 years' time. So that's when we start to depreciate that asset over that period of time. So the methods of depreciation, there's two most common ways of depreciating, and this will depend on the accounting policies of the business. You can have a straight line method or a reducing balance method. You may also hear the second one here referred to as a diminishing balance method as well. Okay, so just consider both of those. So if you see reducing or diminishing, I think sometimes it's changed in the syllabus. I know my tutor used to talk about it as a reducing balance method, and I think now it may well be termed as a diminishing balance method, but it means the same thing. So before we actually move on to doing some calculations for the depreciation, let's just quickly recap on the double entry for some purchases of fixed assets. Okay, so we're just going to do a quick example then of when you purchase an asset. So an example here, so a business purchases a computer for £2,000 plus VAT and pays via debit card. What is a double entry? Okay, so the first thing that we need to think about here is what information the question is giving us. So we know that the computer has been purchased for £2,000 plus VAT. Okay, so this is key here, as we can then tell that this is the net amount because it's plus VAT, not including VAT, plus VAT. So that's good. And we're also told that they pay via debit card. So this is important because this tells us that actually it's a cash transaction, not a credit transaction. So they've already paid for it at the time. So what's the double entry? So what accounts are we going to need here? So the obvious one is going to be the bank account because we're paying by debit card. So let's draw up our bank account. And for those of you that have seen my double entry video, you'll know that I always like to put an arrow at the top of my accounts to help with our dead click. The next account that we're going to need is going to be our asset account. So in this case, it's a computer. So we're going to have our computer account. And then there's also the third account that we're going to need, which is going to be our VAT account. Okay, because we're told in the question we have got VAT. So, how do we record this transaction? So let's have a look. We have to put into the asset account our computer. So if we just have a very quick, whoops, can't quite see that, dead click at the bottom here. Okay. So our computer account is an asset account. Okay, so here's our asset accounts over here. So when we're going to increase an asset account, because we've bought a new computer, so we're going to increase it, we need to debit it. And we're going to debit it with the net amount of the computer. Okay, so our £2,000 goes in here. And then we need to have a look at where the other sides of the transaction goes. So let's think about this. First of all, we know that the bank is going to take the full amount, so it's going to be the net plus the VAT. Okay, so we're going to assume VAT in this question is just the normal UK 20%. So to work out the VAT, you would do 2,000 times 0.2, which is 20% in decimal form, and that equals 400. So our gross amount is £2,400. So it's actually our gross amount that's going to come out of the bank account. So we're going to be reducing our asset this time. So we're not increasing, we're going to decrease it. So we're going to debit the bank account there, credit, sorry, the bank account there, wrote it in the right place, said the wrong thing. So we're going to credit our bank account because we're reducing that balance. And then we can see that we've done 2,000 in our computer account. So we also need to debit our VAT account with the VAT amount. So that VAT amount is what we're going to reclaim from HMRC. So again, it's an asset to us. So we are going to debit it into the VAT account. Okay, so debit the computer account, debit the VAT account, and then credit the bank account with the full gross amount. So let's have another look then, again, just quickly. So a business is purchasing the same computer. So again, we know it's a computer. It's 2,000, which is our net amount, and it's plus VAT. But this time, they receive an invoice with 14-day credit terms, okay? So this is now a credit purchase. We haven't paid at the time of the transaction, we're paying later. So again, what's a double entry? So first of all, we know we're going to have our computer account. That hasn't changed from the previous question. But what are our other accounts? Well, we've still got VAT included in this question. So we know we're going to have a VAT account. And then what's our other account going to be? Well, if you were going to be putting this through from the very start, you're going to have your day book. So it's going to be under your purchases in your purchase ledger. Okay, so you're going to have your purchase ledger control account. So let me just create these properly. Okay, so let me just draw out the so again, Our computer is our asset. So just in the last question, we're going to debit our computer account because we're increasing our asset. We worked out that our VAT was going to be equal to £400 on a £2,000 computer. So because we're going to be able to reclaim that from HMRC, we know that we are going to debit our VAT account £400 because that is also going to be an asset to us. But then our gross amount, so in the last question we credited our bank account because we were reducing the balance on our bank account. But this time we're actually going to increase our purchase ledger control account. And our purchase ledger control account is a liability. So here you can see how the double entry works. We've got 2,000, we've got 400, which makes up our gross amount for the computer, 2,400. And then our opposite side to that is going to go to the purchase ledger control account because we've bought it on credit terms. So we're increasing our liability. So we put the full amount, the gross amount of that purchase into the purchase ledger control account. So the first method then of depreciation is the straight line method. So what is it we actually mean by straight line method? Let's take a look. So the straight line method depreciates the asset at a static percentage per year or to the end of its useful economic life. Okay, so this could mean that depending on the policy, it means you may depreciate the asset at 20%, so you might be given a rate in your question, in your exam, or it might say that the company thinks it has a useful economic life of 5 years. So there's two sort of ways of wording it. It means the same thing, but there are two different ways of wording it. So just have a look at your question. So the straight line method will be set in the company policy, as I just mentioned. So you will have that you depreciate computers like this, you depreciate fixtures and fittings like this, leasehold improvements, whatever it might be. They will be set out in the company policy, and for the purposes of your exam you will be told in the question which method is used and on what basis that method is. And when you're working out your depreciation, you must always take into account any expected residual value, and what this means is value that the company believes the asset is going to have at the end of its life. So if a company thinks that the item, the asset, is going to have a useful economic life of 5 years, at the end of that life they think that the asset is going to have a residual value of £100. And that's really important to take that into consideration, because when you're depreciating over a straight line method, you're expecting to come down to a zero. You're not meant to have a balance at the end of it. But when a company feels that there is a residual value, which probably means they're going to be selling the asset at the end of its life, you need to take that into account, because you need to end up with that residual value by the time you've fully depreciated the asset. So that will become clear when we work out a depreciation example with a residual value. Okay, so just take it into account when you're reading your questions. Highlight, have you got a residual value? Does it say to go down to zero? That kind of thing. And that is also important, that if you do sell the asset, then you are going to have a gain or a loss, depending on how much you get the asset for, or you sell the asset for. So it is very important you take into account what the question tells you about the value of the item at the end of. Okay, so question here then on straight line method depreciation. On 1st of May, a business purchases a computer for £2,000 plus VAT and has a policy to depreciate using the straight line method with a useful economic life of 4 years. It applies a 4 years depreciation in the year of acquisition and none in the year of disposal. What is the depreciation for the year ending 31st of December 2017? So let's have a look at what we're told. We're told that we buy a computer, there's our asset, for £2,000 plus VAT. And we have a policy to depreciate using the straight line method. And our useful economic life is 4 years. So that's the first part of the information we need. But then we're told that it applies a full year's depreciation in the year of acquisition, so the year we purchase it, and none in the year of disposal. What is the depreciation for the year ending 31st of December 2017? So let's have a look. How are we going to work this out then? So the first thing we need to do is have a look at what the key figures are in the question. So we've got our net amount here, which is what we're going to need to put in our asset account, which is what we've done previously. And for the purposes of depreciation, we can forget this. We're not worried about the fact that it had VAT on it because we don't include that in our fixed asset cost when it goes into our T account. Okay, so the depreciation then. So the computer has a value of £2,000. It has a life of 4 years. So each year we're going to have a depreciation of a value of 2,000 divided by 4. So the amount that we are going to depreciate in a year is 500. And that's because there isn't any residual value here. It is a straight depreciation over its useful life of 4 years. So we know how much we're going to be depreciating in a year. So if we just have a look at the question again, what is the depreciation for the year ending 31st December 2017? So we have a look. We purchased it in the same year. Okay, so we purchased it in the same year, but we're told it applies a full year's depreciation in the year of acquisition. Okay, and this just means purchase. So the answer to our question then is it's just going to be this year of depreciation. So it is just going to be £500. So at the moment, I'll do the T account shortly, but at the moment we'll just leave it as the calculation of how you would calculate that depreciation. Okay, so same question then, just with a slight difference. So let's just go through it again and highlight our key points. Okay, so we've got a computer. A business purchases a computer for £2,000 plus VAT and has a policy to depreciate using the straight line method with a useful economic life of 4 years, but they're expecting a residual value of £500. So at the end of its economic life, we're expecting a residual value of £500. It applies a full year's depreciation in the year of acquisition and none in the year of disposal. So what is the depreciation for the year ending 31st of December? So looking at this question then, we can see it is identical to the last question with the exception that this time there's a residual value. So how are we going to apply that into our straight line? So let's go through it again. So our value of our computer, the cost of our computer, is £2,000 when purchased. The life is going to be 4 years. That's our useful economic life. But we've also been given a residual value at the end of that time of £500. So when we've fully depreciated this asset, we want to have a value of £500 left. So let's work through how we'd calculate the depreciation, the year's depreciation. So this time you're going to do 2,000 minus the residual value, first of all, and that's going to give us 1,500. Then you're going to divide that by your life, so your 4 years, which then gives you a depreciation value of £375. So if you just work that backwards, you can prove then that you've got the residual value is going to be right at the end, because if you do your 2,000 minus your first year of depreciation, minus your second year of depreciation, minus your third year of depreciation, minus the last year of depreciation, that does actually come back to your residual value that you're given in your question of £500. So that's how we can tell we've done it correctly. So just go back to the question again. We're asked for the depreciation in the year ending the 31st of December. It's the year that we purchased it. We apply a full year's depreciation in the year of the acquisition. So your answer is £375 is your full year's depreciation on this asset. So our next method is reducing balance method. So this is also known as a diminishing balance method. So I think the terminology has changed a couple of times. I know my tutor used to refer to it as a reducing balance method, and I think now AAT use the diminishing balance method, but they are the same. The depreciation of an asset is based on a percentage per year. And the depreciation amount will reduce each year. And the reason for that is that the depreciation is calculated on the carrying amount of the asset. Okay, so you have your asset cost. You have a percentage each year. We'll go through an example on the next slide, but you have a cost each year, so you have that as your depreciation. And then that will then give you your net book value. Okay. So then the next year, your net book value then becomes your starting amount. You apply your percentage of depreciation to your net book value, and then that gives you your new net book value, and again that then moves up to here, and then that will be your year 3. So here you can see that because we're applying a percentage, because it's done on a percentage, the amount of depreciation will never be the same. Okay, so with your straight line method, your depreciation was the same every year. However, on your diminishing balance, on your reducing balance method, it will always be different, because it will be based on the reducing value of that asset, of the reducing net book value. So you'll see how this works in an example shortly. Again, the depreciation will be, the way that a company depreciates will be set out in its policy. And again, you must take into account any residual value that you're given in your question. So a calculation example then for reducing balance method. So again, we're going to be using the same example of a computer. So let's just go through the question and highlight the important information. So we purchased a computer for £2,000 plus VAT, and it has a policy to depreciate using the reducing balance method at 25% per year. It applies a full year depreciation in the year of acquisition, and none in the year of disposal. What is the depreciation for the year ending 17 and the year ending 18? Okay, so let's have a look then at how we are going to tackle this question. So as we're told that it is it is using the reducing balance method, we know that the amount of depreciation is going to reduce as the years go on. So let's have a look then. The first thing we need to remember is for depreciation, we're not worried about that, so we can just cross that out. We don't want to think about that. All we want is the net amount of our computer. So in our first year, so it tells us it applies a full year's depreciation in the year of acquisition. So remember, that's our purchase year, and none in the year of disposal. So what is the depreciation for the year ending 17? So you can see that we bought it in that same year. So let's put year 1. Because it's the first year, we're going to be basing it on cost. So our cost of our asset was £2,000. Then our reducing balance method is at 25% per year. So we're going to find our 25% of this, and there's a number of different ways you can calculate it. I like the decimal way, but use whichever way it is that you feel comfortable working out your percentages. So when you do your 25% of £2,000, you get 500. Now the important thing to remember here is that your next year's worth of depreciation is going to be based on your new net book value. So year 1, you base it on your cost because you've just purchased the item. This is then our depreciation amount for year 1, which means our new net book value, or our new carrying amount, that's the other term you might see, is going to be equal to 2,000, which is the cost of our asset, minus the depreciation that we've just applied, and that gives us our net book value of £1,500. So our year 1, so our year of acquisition, our depreciation was £500. But this then changes in year 2. In year 2, we're not going to base it on the cost of the item. We're going to base it now on our net book value, on our carrying amount. Okay? So this is how much the asset is now valued at in the accounts. So this time we're going to do our 1,500. Okay, so that's our net book value. Find our 25%, that's our depreciation. And when you do your 25% of that 1,500, you get a depreciation amount of £375 for year 2. Now this is really important because in the previous example, when we were using Straightline Method, we were doing the same calculation because it was over 4 years, and we were coming out at a £500 depreciation. But that stayed the same for year 2, year 3 and year 4. But on your reducing balance method, because you then take the new carrying amount as the amount that you're going to apply depreciation to in year 2, your depreciation reduces from £500 down to £375 in year 2. And that's the difference between the two different methods. Your straight line method would have stayed at 500, but your reducing balance stays at 375. And think of the term reducing balance. So your balance every time is going to come down. So if we finish off then, what this would mean for this year 2 of depreciation, it then means that if we were going to move forward into working out what year 3 is, it is then going to be your carrying amount of 1,500 minus your new set of your new amount of depreciation, and when you take that away, it gives you a new net book value, a new carrying amount of 1,125. So again, that has now reduced down. So in year 3, if we were going to work it out, you would then start with your £1,125 and then multiply that out by your 25%. But the question is only asking us for the first year and the second year. So your depreciation in year 2 is 375 and in year 1 it was 500. Okay, so we're going to have a look at another example now of another calculation for reducing balance. So here we have on the 1st of May 7, a business purchases a car for £12,000 plus VAT and has a policy to depreciate using the reducing balance method at 18% per year. It applies a full year's depreciation in the year of acquisition and none in the year of disposal. What is the depreciation for the year ending 31st of December 8 and 31st of December 9? Okay, so let's have a look now then at what the question is actually asking us. So the first thing I do is I like to go through and highlight the key points. So we know which year it was purchased in, we know what we've purchased and how much we've purchased it for. We're told that we're going to be using the reducing balance method and it's going to be at 18% per year. We know we have to do a full year's depreciation in the year of acquisition and we don't do any in the year of disposal. So what is the depreciation for the year ending 8 and the year ending 9? So the first thing here then is to say that actually we are only interested in year 2 and year 3 because we purchased in 7, so that's our first year there. But actually the question is asking us for our second year and our third year. So let's start it from the beginning. So the first thing we need to do is have our costs. Now we need to forget about VAT. VAT doesn't come into depreciation. So we do our cost. Of 12,000. We're told our depreciation is 18% per year. So you work out 18%. And that will give you a depreciation of 2,160 in year 1. So in order to then work out what year 2 is, we need to know what our carrying amount is, what our net book value amount is, because remember, we don't base diminishing balance on the cost all the time. We only base it on the cost in year 1, and then we base it on what the asset is then valued at in our accounting records. So our net book value is then going to be 12,000 minus the 2160 depreciation, and that gives you a new value of 9840. So then year 2. So we then do our net book value, we bring that down, we multiply that out by our 18%, which gives you 1,771. I'm just rounding to the nearest pound. And that is your depreciation for year 2. But we still know that we need to get to year 3. So again, we're then going to do our net book value figure. So we're going to do 9,840 minus the depreciation, and that is then going to bring us out at our new figure of 8,068. It takes into account a little bit of rounding there. So then for year 3, we're going to do our net book value of 8068, multiply that out by 18% for our depreciation, which will give us, again with a tad of rounding, 1452, and that's our year 3. And then if we were going to continue, we would use our new net book value, which would be the 8068 minus our year 3 depreciation, and then our new net book value would then be 6616. So going back to the question then, what is the depreciation for the year ending 8 and 9? So we already identified that 7 was our first, 8 as our second, 9 was our third. So our answer would actually be 1711 in X8 and 1452 in X9. So let's have an overview then of the T accounts that are used in depreciation. So the 2 accounts, first of all, that we will use for recording the depreciation, you're going to have your depreciation account and you're going to have your accumulated depreciation account. So I'm just going to bring up our dead click up here in the corner so that we have it to remind us while we go through how we put a figure into these depreciation accounts. So once you've worked out your depreciation, so we're not going to do a full example on this slide, we'll do one on another slide. But once you've worked out your full depreciation, so for the purposes of this slide, let's say our depreciation figure is £500 per year, and that's what we'll use just as this example. So for the depreciation then, we need to have a think of what type of accounts are there. So what type of account is a depreciation account? Well, that depreciation is going to reduce the value of the asset in the accounts. So we need to consider it as an expense account. So this is important to recognise because although it's not, it's considered non-cash, therefore it doesn't affect your cash flow or anything, it is considered an expense account, and for the purposes of drawing up your T accounts, this is going to be how you recognise it. So your depreciation account is going to be your expense account. So we're going to have an expense account here. But your accumulated depreciation account, so this is where you add up the amount of depreciation that's going through on your particular asset. So at any given point, you would be able to tell what your net book value is, what the value is of a specific asset is in your accounts. And by doing that, you would have the original cost of the asset minus any depreciation, accumulated depreciation, and that would give you the net book value of your asset. So the way to think about this is that this is effectively, it's like having a liability, because that depreciation is going to reduce the amount that your asset is worth to your business, that you value your asset at. Okay, so we're going to treat it as a liability. Now the other two differences about these accounts is that this one is going to be considered to be on your P&L, your statement of profit and loss, and this one is going to go to your balance sheet, your statement of financial position. And that's important because your asset account for your computer, your car, your fixtures and fittings, that is also sitting on your statement of financial position. So that means you've got your cost account and your accumulated depreciation account, and then you can work out the difference between the two, and that's your net book value. So you have both of those accounts on the statement of financial position. So if we draw up a quick T account, oh, that is very wonky, I apologise for that. So we've got this depreciation here of £500 per year. So our depreciation, we're going to be increasing our depreciation. So here's my little arrow on my dead click again. So we're going to increase our expense. So we've identified this as our expense account here. So we're increasing. So we're going to have £500 debited to our depreciation account. At the same time, we also need to make sure that we are reflecting that, so that that £500 is reflected in the net book value of that asset. So we need to reflect it as well on your statement of financial position. And we're going to consider this a liability to us because this is going to take down the value of our asset. So a little bit straighter. So here's our T account for our accumulated depreciation. So this £500, yes, straight away you can see that the opposite entry is going to be a credit, but make sure you understand why it's going to be a credit. And the reason for that is because we are now going to increase our accumulated depreciation account. So we're increasing a liability, and our liability is on our credit side of our dead click. So then in the next year, you would then apply another £500 in your depreciation account. You would debit your depreciation account, so your expenses have increased. And then when it comes to your accumulated depreciation, you would have another 500 in there. So think about it that in each year, for your depreciation account, each year you would see 500, but in your accumulated depreciation account, in year 1 you would see 500, in year 2 you would see 1,000, and in year 3 you would see 1,500. And that's how you would then bring down the value of your asset in the accounts to show the true net book value. So we're going to move on to an example which will just walk through this a little bit in more detail for you. Okay, so let's work through the example that we had, one of our first examples that we went through earlier. So just to highlight the important parts, so we know the year that we've purchased in, we know we're purchasing a computer, and we know it cost us £2,000. We're going to use the straight line method, and it has a useful economic life of 4 years, and we're expecting a residual value of £500. We're told it applies a full year's depreciation in the year of acquisition, and then none in the year of disposal. And we've asked to be shown the double entry for the year ending 31st of December 17. So the first thing I'm going to do is I am going to bring up a little dead click up the top there. And I would really stress this in your exams, is just draw yourself on the paper that you're given, or request a bit of paper from the invigilator, and just draw out dead click on your paper with your little arrow, and then it's always there to remind you for this exam and all of your exams. And I still do it now, even when I'm at work sometimes I'll draw it out, and it just helps to sort of get your thinking in the same pattern, which is very useful. So we know the 2 accounts from the slide that we were just on. So we're going to have our depreciation account, and we're going to have our accumulated depreciation. And from the previous slides, we know it's the same question, so we know that we were going to be applying the depreciation on a value of 1500 because we need to take out our residual value first. We're going to divide that by 4 years, and that gave us our annual depreciation of 375. Each year, that's the amount that we need to depreciate by. So for the first year then, we've got to apply a full year's depreciation. So in our depreciation account, this is our expense account. We want to increase our expense. We want to apply the depreciation. There's our expense account in dead click. So we're going to debit our expense account. Help if I write the right number. 375. And our opposite entry is in our accumulated depreciation account. So we credit that account. And why do we credit it? We credit it because we consider it our liability account because it's going to reduce the value of our asset. And our liability account sits on the credit side. So when we're increasing that liability, we need to credit. So that's how you apply your double entry for that first year. On the next slide, we'll go on to having a look at when it's in the second year or another year, and how the accumulated depreciation works in that instance. Okay, so bringing up that question again, and let's bring up our dead click in the corner. So it's the same question, but the only difference here is that we're told at the year ending 31st December 7, which is the year that we purchased in, a full year's depreciation was applied. And that's important because we know that we're now going to have something already in our accumulated depreciation account. So just to draw the accounts again, so our depreciation is our expense account. and we consider this our liability account. So we know that because we applied a full year depreciation in the first year, we're going to have our so it's our 375 per year, because we've already calculated that. We're already going to have in our accumulated depreciation account, in our statement of financial position, we're already going to have £375, because that is from the first year. So in our second year, what we need to do is we need to apply the depreciation again. So we haven't got anything in our depreciation account, because the first year that's all been shut off now, that's all closed. So our expense account, our depreciation account is now at 0. So we're going to apply the depreciation in the year. So we're going to debit, we're going to increase our expense account, debit our depreciation account. And we're also going to credit, our opposite entry is credit the accumulated depreciation account. And then what that does is that brings our depreciation in total to £750. And that's really important, because when you're looking at your statement of financial position, when this gets transferred to your statement of financial position, that £750 is going to reduce the value of the asset that's sitting in the cost account. So the cost account that we done earlier on in the presentation with the bank or the purchase ledger, that's done, but that cost needs to be reduced. So our net book value of that asset needs to be reduced. So our net book value on our statement of financial position, our net book value of this particular computer that we've got here, would be the original cost of the computer less our accumulated depreciation and that will give us our net book value as at the end of our second year, at the end, where are we? At the end of this year here. And that then shows you how your depreciation account, your expense account, you only have 1 year's worth of depreciation in it, but your accumulated depreciation all gets added up together over the years, and that's what then helps for you to calculate your net book value at any given time. Okay, so just some final thoughts then for this video. We've got 2 different methods for depreciation. We've got our straight line or our reducing balance method. And remember, that can also be diminishing balance method as well. Always check your question to see if there's going to be a residual value, and that residual value needs to be taken off the cost of the asset before applying your depreciation. Remember, your depreciation is an expense account for when you're applying your dead click to your double entry. And your accumulated depreciation is considered a liability account because it reduces the value of your asset in the statement of financial position. And then the next step on from the video that we've done today will be a video on how to dispose of an asset and what happens to the accumulated depreciation account, but I will do that in a separate video at a later date. Most importantly, practice, practice, practice. Get as many questions as you can, different question banks, different providers, talk to your tutors. It's really, really important that you practice this. You have a look at the straight line and reducing balance, and you just go through it over and over and over again, and it will help. And finally, always make sure you read the question. Look at the dates in the question. What year are you calculating? Are you given any accumulated depreciation? What percentage are you given? really make sure you break down the question. Write yourself a couple of little notes on paper or something. Just break it right down, because it's so easy to answer a question that you feel comfortable answering rather than the question that's on the screen in front of you. So make sure you take a breath before you start, and break the question down into little bits and identify what it's asking you. And finally, good luck!